Hello, I'm Chuck Inglefield, founder of Inglefield Retirement Solutions, where we work with investors to make confident financial choices about their retirements. This is my quarterly economic update for the first quarter of 2024. Our agenda for this quarterly economic update will cover four areas. We're going to look at what happened briefly in 2023 and then what to look for in 2024. We'll start with a focus on the economy. We'll then move on to stocks and bonds. We'll talk about inflation and the Federal Reserve. And then finally, I'll wrap up with a short discussion about the election and how that might impact markets. For those of you who are impatient or just don't have time to watch the whole video, here's a quick summary of what you're about to learn or what you would learn if you listen to the whole economic update. So firstly, on the economy, there was an expectation of a recession in 2023 that never showed up, mostly because of consumer spending. There is still a look for a potential recession in 2024, or we might be able to pull off that proverbial soft landing. Still too early to tell on that. With regard to stocks are moving into what should be a favorable environment with lowering interest rates expected this year, as well as inflation continuing to lower. Both of those tend to be positive environments for stocks. Next, bonds can stand to benefit by lowering interest rates from the Fed as far as price appreciation goes. Yields on bonds have gone up, so that's a good thing, and we're seeing those contributions to our portfolios. If we compare that with some price appreciation in 2024, they should be a nice contributor to our portfolio returns. Finally, with regard to the election, the final year of a presidency tends to be a positive year, not nearly as rewarding as the third year of a presidency. So I don't see that currently as making much impact on the markets. It's really going to come down to economic fundamentals and corporate earnings to determine how well markets do, specifically stock markets, in 2024. So that's the quick summary. For those of you interested in the detail, let's start out with a discussion of the economy. So the economy, are we looking at a recession or potentially a soft landing in 2024? It was interesting because in 2023, there was a strong expectation for a small or mild recession, and that never occurred. In fact, as we look at the GDP numbers here, you can see that, frankly, the third and fourth quarter of 2023 were very strong. The fourth quarter coming in at 3.3%. Overall GDP grew at 2.5% in 2023. So there was no hint of a recession. And what is a recession anyway? Well, recession is defined by 2 quarters of negative GDP. So we didn't see that in 2023. The question is, will we see that in 2024? I think some of the same factors are going to play into our economic results this quarter. So I want to focus on this next slide. In the upper right, you'll see a statistic called household excess savings. And this is really a lot of the money that's still left from what was pushed out from the government during the pandemic, which helped us avoid a very deep recession, if not a depression. And so some of that money is still available. It's what drove growth in 2023. There's still enough in here where it might play a big part in 2024 to avoid a recession. That said, let's take a look at some leading economic indicators that I think are a little bit better as predicting where the economy might be headed. So these are called the Purchasing Managers Index. So let me describe that for those of you that just seeing this for the first time. Purchasing Managers Index is a survey of purchasing managers, both in the manufacturing sector and then also in the service sector. And they're questioned about what they see happening in their businesses. And they're looking forward to what do they need to order for their businesses, what's the demand, what's their order backlog. And so it's a really good leading indicator of where their industry might be headed. And so as we look at this index of manufacturing activity chart, we want to focus on the blue line. The red dotted line is just the Richmond Fed, it's more regional. The blue line is the national economic indicators. And if the blue line is below 50, so that midline you see on this chart, it means that they're experiencing contraction or expected to experience contraction in their businesses. If it's above 50, they're looking at expansion in their businesses. And you can see we've been below 50 on the manufacturing side for quite a while here. And I think this is a bit of the hangover of demand shifting from goods to services once the pandemic started to phase out and we started to get out and be able to travel and go to restaurants and so on and so on. So it's been mildly negative. You can see it trended up recently here in January, but still showing a bit of contraction, not severe contraction like you saw back in, and you can see this on the far left side of the chart, like we saw in the Great Recession of 0809. And then you could see briefly that spike down at the beginning of the pandemic in March of 2020. Something to keep an eye on as far as if this starts to trend lower. But this is really only about 1/5 of the economy at this point. Services makes up a larger portion. So let's take a look at non-manufacturing or services PMI. So services PMI, you can see, is above 50, although it's been trending down towards 50 recently. And so we're starting to see potential canary in the coal mine here of, okay, we're not as strong as we've been in the last year or two. And so we're still in expansion mode, but not robust expansion mode. I can assure you that the Federal Reserve is looking at these indicators as part of their consideration of when do they start to lower interest rates to avoid sending the economy into recession. I mentioned, are we going to have a soft landing? And that's what the Fed is trying to achieve. They raised interest rates to try to tame inflation, and that is working. However, if you overdo it, you'll send the economy into a recession. So they're trying to balance continuing to fight inflation while preventing a recession. And you can see we're sort of at that fine line right now. 2024 will play out month by month, and I think create a little bit of volatility because some of the monthly data, like the January data on inflation, is going to move in the wrong direction. However, the overall trend is moving in the right direction. So for them to achieve this soft landing, they'll need to start to lower rates before the economy slows too much. We will talk more about interest rates and inflation later in this presentation. So let's now move on to investing. In this investing section, we're going to talk about both stocks and bonds. So let's talk about stocks first. And are we seeing an improving landscape for equity markets in 2024? And the fact of the matter is yes, and we can see the detail of this on this next slide. Two big things are happening in 2024. First, inflation has been trending down and it's getting closer to the Federal Reserve's 2% target. Interest rates are expected to also begin trending down, although modestly in 2024. But lowering interest rates and lowering inflation are both good tailwinds for equity markets. It improves what they call risk appetite, which means people are more willing to invest into equity markets in that scenario, and that's based on history. So as we move into 2024, it will bear noting what's happening with both of those factors, interest rates and inflation. A good example of how this might create some bumpy rides in 2024 on a month-to-month basis, as we get data released, if anything shows that these trends have stalled or move in the wrong direction, equity markets will respond relatively quickly. So on Tuesday of last week, we saw the inflation number come in worse than expected. In fact, it ticked up a little bit versus ticking down a little bit. And on that day, equity markets dropped nearly 2%. So the market reacted very quickly to the concern of, hey, maybe inflation's going to be around and be more stubborn than we thought. And that means the Federal Reserve is going to be slower to lower interest rates. And I think month to month, we're going to see that same type of reaction or same type of response. So I think 2024 might be a bumpy ride for equities. More important than that is going to be corporate earnings, and that'll factor into valuations on stocks. So let's take a look at current valuations on stocks. And many of you have seen this slide before if you watched my economic updates. And what this shows is the forward PE ratio for stocks versus its average over the last 25 years. Scratch that. They've updated this slide. It now looks back 30 years because I think we want to pick up the dot-com era of the late 90s. So what we see here is, as you see this line on the chart go above the top line of one standard deviation, it means that stocks have become a bit pricey. And the opposite is true when the line is below this bottom line of -1 standard deviation. It means stocks have become, frankly, cheap relative to history. And it can stay above and below that line for quite some time, but the majority of the time it stays within those two standard deviations. You can see we've approached the top line at this point. So valuations on equities are rich. I think the market is pricing in that trend on inflation and interest rates already, which is why a bumpy ride could happen if a monthly data point contradicts expectations. From this point forward, earnings are going to matter more and more for equities to continue to do well. And so let's take a look at expectations for earnings, because when we look at earnings, one of the things that can pull down this line is if earnings beat expectations. So we don't need a stock market pullback to pull down this line to more fair valuations. Frankly, if earnings exceed expectations, we will start to see that line come down naturally as well. So let's take a look at what the earnings projections are going forward. And you can see here in the next couple of years, earnings are expected to be low double-digit growth. So that's a good thing. In fact, this earnings season, we're already seeing companies beating expectations. So very, very good from that standpoint. LPL does a great job on research publications, and they pointed out potential 5 surprises for 2024. And if you're interested, I can send you this publication. But I want to point out one thing here that is interesting as of what occurred last year. And it's this idea that if the AI, artificial intelligence optimism takes a breather, what drove the top line index returns last year was enthusiasm about artificial intelligence stocks. What we saw in the market was those had fantastic returns that year or last year, but the broader market didn't participate as fully. And so when we look at the indexes, they're weighted. The top 10 companies make up a larger weight than the bottom 10 companies, for example. And so the S&P 500 index, 500 companies represented, but they're not represented equally. What's interesting on this next slide, you can see just how much impact the top 10% of stocks have on the market. So when we look at this chart on the upper right, the weight of the top 10 stocks on the S&P 500 has increased to 32.8%. So roughly a third of the index performance is a result of how those top 10 companies are doing. And this has created a bit, I think, of distortion of when you look at how the index did versus how a broadly diversified portfolio that didn't fully weight those top 10 as they are in the S&P 500. That top 10 includes a lot of the artificial intelligence stocks, what were called the Magnificent Seven in the overall index. And so as we move forward, if there is a pause in that enthusiasm, it will have an outsized impact on the index performance. What this suggests is we need to continue to be broadly diversified in our portfolios, not just within the U.S. stocks that we're owning, but including emerging market and international stocks as well. So now let's move on to our discussion of bonds. As I've talked about in the past, interest rates and bond prices tend to move opposite of each other. So as interest rates come down, as they're expected to do this year, bond prices tend to increase. So that's the tailwind we might have coming into 2024. Because interest rates have increased over the last few years, we're earning more interest on our bonds, but we're also looking at the potential for price appreciation, as we see here on the teeter-totter. Now, on this teeter-totter, you can see I've added maturities, which is just the length until a bond matures. You can see that as you go out on the teeter-totter with a longer maturity, your potential for price appreciation tends to increase. However, we're not in a normal bond market where it's a linear relationship like this. In fact, we're in what's called an inverted yield curve, which means that, frankly, you'd have to warp this half of the teeter-totter based on bond prices. And so let me show you what an inverted yield curve means. So we're looking here at this top line. This inverted yield curve shows that short-term rates are actually higher than longer term rates. So we'd have to warp our teeter totter. And it's possible that we're going to see some nice appreciation on the shorter term side relative to the longer term side than we would with a natural yield curve in the bond market. So I want to dig in here and show you some numbers of how we might see an impact of a 1% fall in interest rates. And so we'll look at this chart on the right. We want to look at the blue bars here, which show the price appreciation of what could happen for different maturities if interest rates fall by 1%. So let's look at the top two. So a 2-year and a 5-year treasury. And you can see that a 2-year might appreciate by 6%, which is fantastic. A 5-year maturity would appreciate 8.3%. Now let's just jump down to the 10-year. And you can see that it could appreciate by 11.7%, projections show. However, let's now look at the gray bar on the left side of these bar charts. That shows the downside if interest rates actually went up 1%. Why would they go up? Well, let's say inflation starts to increase versus decrease or stays higher for longer. The Fed might actually want to increase rates. They definitely want to tackle inflation. And if it took a recession to do so, they will. So the downside on the 10-year treasury, if rates went up 1%, is negative 4%. Again, the upside's 11.7. Let's go back to that 5-year treasury. The downside's negative 0.7, upside 8.3. To me, that represents a better trade-off than the 10-year or longer maturities do. So we've tended to be on the shorter end of the duration or maturities in our portfolios. And I want to continue to stay on that end for now. Again, really gets back to that inverted yield curve, which is changing how we might otherwise position bond portfolios in a lowering interest rate environment. Let's wrap up our discussion of stocks and bonds with a look at a balanced 60-40 portfolio, because over the last few years, I've heard, 60-40 is dead. You can't trust that as your overall strategy anymore. And I would beg to differ on that front. This is a bar chart of returns for a 60-40 portfolio going back to 1950. And I'm not going to get into the detail. I just want to take a broad look at this. If you look at this portfolio, if the bar is above the line, so going back to 1950, you can see there was a positive return of 13%. It means there was a positive return for a 60-40 portfolio. If the bar is below the line, it means there was a negative return for the 60-40 portfolio. And if you look recently, 2021 was a terrible year for 60-40 portfolios, which is why they said, the 60-40 is dead. It's not dead. In fact, if you look at this diversification between a stock and bond portfolio is very smart over the long run, especially for retirees. If you just look at the number of up years versus the number of down years, you're really seeing that, hey, this is a pretty good strategy from the standpoint of putting yourself in a position for a likelihood of a positive return versus a negative return over your retirement lifetime. Let me put some numbers to that. So let's take a look at the table here on the upper right that discusses the actual returns going back to 1950 of the different asset allocations. So a full stock portfolio has an average annual return in that period of time of 11.2%. Bonds are 5.5%, more conservative part of the portfolio, tends to have a lower rate of return, but provides some stability in our returns. But look at the 60-40, 9.3% average annual return since 1950. I do retirement plans. I know that if we had a 9.3% return on retirement portfolio, this is a scenario where if your spending is in line with suggestions, you do not have to worry about keeping up with inflation. You do not have to worry about running out of money during your retirement. So 60-40 is not dead. It seemed to be trendy because of 2021. I am still a firm believer in putting together the right balance of stocks and bonds for each individual client scenario. And 60-40 might be it, 70-30 might be it, 80-20, everything in between. But having that balance of stocks and bonds, to me, still makes sense. So let's now move to inflation and the Fed. As I've said throughout this presentation, it matters when the Fed begins to cut interest rates. And that's what the market's looking at. That's what it's going to respond to, both the stock market and the bond market. So let's take a look at when that might happen and why it might happen. LPL put together forecasts for 2024 growth. And at this top line, you can see US growth, GDP, is expected to be 1%, down from 2.5% in 2023. And they expect inflation to drop to 2.8%, much closer to the Fed's 2% target. So if we start to see GDP growth slow, maybe more than expected, and I would say 1% is pretty slow GDP growth because the average trend over the last 50 years has been 2%. That's going to give the Fed a larger incentive to begin lowering rates so they can try to get that soft landing and avoid a recession. If inflation does start trending under 3%, I think the Fed is definitely going to move on lowering interest rates relatively soon thereafter. We saw the number tick up above 3% when it was expected to come in around 2.9% in January. And both the bond and stock market responded in a negative manner to that news. But again, that's monthly data. I think it's very possible that we'll see different data in February and March that could change what the market thinks about the timing of interest rate decreases. So let's take a look at what the Fed is projecting and what the market's projecting. So when we look at this chart here, the blue line is what the Fed thinks they're going to do with interest rates. The gray line is what the market thinks they're going to do with interest rates. So you can see all the rate increases that we've seen since early in 2021. And we've been on pause really since last summer. The expectation for 2024 by the Fed is they're going to drop rates about 0.75 of a percentage point this year. The market thinks they're going to drop it about 1.25, maybe a little bit more than that this year. If you think back to the numbers I showed you on the bond chart and what that would do with bond prices, that could be a really good thing. And then you can see the Fed is actually projecting to lower rates pretty meaningfully, and I would say fairly rapidly over the next few years. So a really good backdrop. The question is, when will they do it? I think it's a combination of what's happening with GDP and what's happening with inflation. The data will be noisy month to month. So I think the markets will be a little bit bumpy month to month. But this year, almost assuredly, we will see interest rates start to fall. That's a good backdrop for stocks and bonds. Let me wrap up with the discussion of the election and the impact that might have on markets or not. So with the election, how do we think markets are going to react? Well, let's take a look back at history and look at how markets have done through prior presidential years. And just if you look at this chart on the right, I don't really want to spend time on the chart on the left because it's talking about combinations of political parties and so on and so forth, which we frankly aren't going to know. But if you look at the first, second, third, and fourth year of a presidency, the third year tends to be the best. And that was true last year. Last year was a very good market year. And then if you look at, and this goes back to 1937, so soon after the Depression, the market has averaged a 9.9% return in that fourth year of a presidency. And if you go back to 1950, every fourth year of a presidency has been positive. So let's hope history repeats itself. I will tell you, I don't use this data to guide what I'm doing in the portfolio and make a portfolio decisions. It's kind of a question that keeps coming up. I thought I'd share some historical data with you. Take it for what it's worth or what it's not worth. So that wraps up the economic update for the first quarter of 2024. I'll be doing the next update on May the 4th. And so we will be doing that at our breakfast meeting in person. We'll also post that on YouTube. But I appreciate your attention if you stayed with me this long, and hope to see you at the next economic update.